All right, today we're going to tackle one of the most stubborn and honestly, kind of depressing facts in finance. We're going to dig into the psychology behind it, which is so counterintuitive and it separates the consistent winners from, well, everyone else. So you can see what it really takes to succeed.
I mean, it's a brutal statistic, right? But study after study confirms it. Something like 90% of retail traders consistently lose money over the long haul. And what's crazy is that even with better tools, tighter spreads, and more information than ever before, that failure rate has barely moved in decades. So what is really going on here?
So where do most people look for an answer? The strategy, of course. The thinking is, well, the 90% must just be bad at reading charts. They just need a better system, or some secret indicator, or maybe that one hidden pattern that's going to unlock the whole market. But here's the thing. What if that's the wrong question to be asking in the first place?
Look, the truth is, the problem usually isn't about not understanding your MACD or messing up a Fibonacci retracement. A lot of losing traders actually know their technical analysis inside and out. The real issue here is so much deeper. It's not about the charts on your screen. It's about the wiring inside our own heads. It's a human problem.
Okay, let's dive into the first and, honestly, the most costly myth that traps new traders. It's this idea that's so deeply baked into our brains from childhood that it just feels right. But in trading, it's completely destructive.
I love this quote because it just flips everything we think we know on its head. Just think about it for a second. We're all taught to hunt for bargains, right? To buy stuff when it's on sale, when it's cheap. But in the markets, that one simple piece of advice can be an absolute recipe for disaster.
And this is where it all goes wrong. This is the core conflict. In a supermarket, if your favorite coffee is on sale, you'll load up, right? A discount means you're getting a great value. But in the financial markets, a stock that's getting cheaper isn't a bargain. It's a sign of weakness. Applying that supermarket instinct to trading is like trying to play basketball with a football. You're using the wrong rules for the game.
And hey, this isn't just some abstract theory. Let's look at a classic real-world example, Northern Rock. When the stock was flying high, rallying almost 90%, nobody was interested. Crickets. But the second it started to fall off a cliff, suddenly their phone lines were blowing up. Everybody wanted to buy the bargain. They saw this as a rare opportunity to get a good stock on the cheap. And they kept buying that bargain all the way down to zero.
All right, let's move on to the next major trap. So if the first myth is all about our buying instincts getting us in trouble, the second one is this belief that we can somehow think our way to victory. If we just find one more indicator or one more secret chart pattern, we'll crack the code. I mean, there's a whole industry built on this, right? Selling the idea that more complexity is the solution. And it's so seductive. It's so tempting to think there's some secret ratio or a magic combination of indicators that the pros are using, and if we just learn it, we'll be set.
But think about this. Here's the paradox. Today, we have pattern recognition software, news that hits our screens in milliseconds, tools that traders 20 years ago would have killed for. And yet, that 90% loss rate, it hasn't changed at all. So if all these fancy tools were really the answer, shouldn't we be seeing better results by now? What does that tell you about where the real edge is?
This is such a perfect example of what I'm talking about. The book that's basically considered the Bible of technical analysis has sold over 1 million copies. It's everywhere. But get this, it wasn't written by legendary traders. It was written by journalists. The point is, the knowledge is out there for everyone, but actually applying it successfully, that's what's rare. The edge isn't in what you know, it's in what you do.
Okay, so if the supermarket mentality is a trap, and just piling on more technical analysis isn't the answer, then what in the world separates the winners from the losers? Well, it really comes down to flipping our natural human instincts completely upside down. Let's take a look at what that winning 1% is actually doing.
Check this out. This data comes from a massive study of 43 million real trades. Now, you'd think losing traders are just wrong all the time, right? That they guess wrong constantly? But look at the hit rate. The average trader here was actually right more often than not, 62% of the time. So, what gives? The problem was that their average losing trade was almost double the size of their average winning trade. In other words, they were absolute masters at snatching tiny profits and just terrible at cutting their losses short.
And this all boils down to a massive psychological trap. So when a typical trader is in a winning position, they're not hopeful about it getting bigger. They're terrified that the profit will vanish, so they grab it way too quickly. But when they're in a losing trade, suddenly they're not fearful at all. They're hopeful. They're praying it'll turn around, so they let that loss run and run. The top 1%? They learn to do the complete opposite of that.
The legendary trader Richard Dennis proved this with his famous Turtle Traders experiment. He took a group of total novices and taught them this almost ridiculously simple system. The rule was, if the market hits a new 20-day high, you buy. If it hits a new 20-day low, you sell short. You buy strength, you sell weakness. But the real secret sauce wasn't the entry. It was the one ironclad rule. You were absolutely forbidden from taking your profits early. You had to let them run, no matter how uncomfortable it felt.
And this quote from one of the actual turtle traders who went through the program just says it all. The hardest part of a system that made people millions of dollars wasn't some complex analysis, because there wasn't any. It was the mental discipline to just do nothing, to sit on your hands and fight that overwhelming urge to tinker, to grab a small profit, to escape the discomfort of having a big winner on the books.
All right, let's bring this all home. The path to joining that 1% club, it's not hiding in some book of secret chart patterns or in a new piece of software. It's found by looking inward, by fundamentally changing how you react to winning and to losing.
You know, Richard Dennis himself said it best. Success in this game isn't about staring at your charts until your eyes bleed. It's about staring harder at yourself. It's about understanding what's going on in your own mind, your natural reactions to fear and greed, and then learning how to act against those instincts.
To really drive this point home, I want to use an analogy from a completely different world. This guy right here is Alex Honnold. He's the only person to ever free solo climb El Capitan. That's a 3,000-foot sheer wall of rock with no rope. It's one of the most incredible physical feats of all time, for sure. But that's not the whole story.
I mean, of course, Honnold spent years and years doing the physical training. He had to. But what people don't always realize is that he spent just as long, if not longer, mentally preparing, rehearsing every single move, visualizing every possible scenario, training his mind to stay in complete control under pressure that is, well, it's unimaginable. At that kind of elite level, the edge isn't physical anymore, it's mental. And you know what? Trading is exactly the same.
So as you go back and look at your own trading, the final question to ask yourself is this. Are you spending all of your time and energy on the technical preparation, the charts, the indicators, the systems, while completely neglecting the mental training that truly makes the difference? Because your answer to that question is probably going to determine which group you end up in, the 90% or the 1%.